A very good morning, everyone. You folks never fail to surprise me. I'm so impressed with the turnout for this 180th weekly webinar session on a Sunday morning, when we usually wake up to a laid-back, agenda-free day. But as you all know, we at AABN have been trying to transform this lethargic phase into a productive phase by presenting to you a gamut of technical and business experts and seasoned speakers to talk to you about upgrading core skills and competencies relevant to changing times and future challenges. So at the outset, I owe each of you a big thanks for logging, and I assure you that the next 90 minutes is definitely going to be a rewarding experience with useful takeaways for us. Yes, I'm saying this with confidence because such is the profile of our guest speaker today. Dr. PC Narayan, retired professor, Indian Institute of Management, Bangalore, will share his perspectives on time value money and its impact on investment decisions by companies and individuals. We extend a very warm welcome to our eminent guest speaker to this interactive business networking session. When it comes to making financial decisions, the concept of the time value of money plays a crucial role. Understanding this principle can significantly impact your financial planning and investment strategies. Understanding the time value of money is essential for various financial decisions such as investing, budgeting, borrowing, and evaluating investment opportunities. It helps individuals and businesses make better financial choices by considering the potential impacts of time on the value of their money. It can assist in determining the appropriate amount to save for retirement, analyzing the profitability of investment projects, or deciding whether to take out a loan or pay cash for a purchase. In this webinar today, Dr. PC Narayan will dwell into the time value of money, its importance, and how it can affect your financial choices. It will take a good part of today if I have to run you through all the achievements of this illustrious speaker. Dr. PC Narayan is a faculty member in the finance and accounting area at the Indian Institute of Management, Bangalore, where he has been teaching since 2003. His areas of research interest and expertise include risk management, banking and financial markets, international finance, regulation and monetary policy and technology related to banking and financial markets. He has a bachelor's degree in chemical engineering from NIT Trichy campus, PGDM from
இது வந்து
XLRI,
ஜஸ்ட் இது
and a
எவ்ரி சண்டே
PhD
10:30 ஒரு ப்ரோக்ராம் இருக்கும். எதாவது எனக்கு
and
பிடிச்ச ஜாயின் பண்ணுவேன் இல்ல ஜாயின்
and a PhD from Indian
பண்ணாங்களே
Institute of
யூனிவர்சிட்டி.
Technology, Madras.
இது
His,
ஃபினான்ஷியல்
his
ரிட்டையர்மெண்ட்
PhD
பிளானிங் அதை
thesis
வச்சுட்டு சொல்றாங்க.
his PhD thesis won the Outstanding Doctoral Research
நீங்க
Award
கேக்குறதுனா இதுல
of the European Foundation for Management Education and Emerald Publishing in 2013. He won the Teaching Innovator Award 2016 from the Ministry of Human Resource Development, Government of India, for his innovative and effective use of technology in the graduate classroom. He was a member of the advisory group of the Unique Identification Authority of India, set up by the Government of India in 2009. He consults for and trains managers in several organizations in India and abroad in the banking, manufacturing, and information technology sectors. Prior to joining IIMB, he was based overseas for several years with a multinational bank and subsequently as the president of a bank in India. Having spent many years in industry as well as in academia and having traveled to over 40 countries and having worked in 20 different countries, he brings a breadth of global experience and a unique cross-cultural perspective in his teaching and research. With a personality like Dr. PC Narayan, you can go on and on eulogizing. But let me stop here and let the audience have the privilege of listening to you, sir. Before I wind up, let me once again extend a warm welcome to all and reiterate that the AABN's doors are always open to those who might want to strengthen our work with the suggestions. I also wish to place on record a deep commitment to work tirelessly as a team to carry forward our goals in a constructive, gratifying way. We also take this opportunity to thank Mr. N.S. Murthy for his support to connect us with Dr. Narayan. Thank you, and over to you, Dr. Narayan.
Thank you. Thank you. One of you is on the phone, has not muted your Narendra Babu, please mute yourself. Thank you. Thank you very much. Good morning, gentlemen. I only see gentlemen. I don't know if there are any ladies, so I will say gentlemen. Quite pleased to see that you've got 77 who signed in at this point in time. I will share my screen and then get started with the topic at hand. Just give me one moment. I will set myself up in a way that there will be no interruptions during the session. Yeah. Okay. Time value of money is to the world of finance what, for example, Pythagoras theorem is in geometry, or dy by dx is in uh, mathematics. It's very basic. Unfortunately, most people don't understand it, and they put truckloads of money in their businesses and investment decisions and find that it goes wrong. Now, this is one of the sure short ways to make sure this technique, which I'm going to talk about, time value of money, net present value, internal rate of return, to try and see how we can minimize the possibility of negative outcomes. Remember, when we're running a business, there are two important decisions we need to take when we're running a business. There are many, but the two important ones are relating to finance. One is financing. One is investing. Where do we invest? What kind of projects do we invest in? Will it make me richer or will it make me poorer? Now, this is the call you have to make right at the start. The second is, how am I going to finance those decisions? How much of my own money am I going to put into the business? How much debt I will raise? That means either go to a bank or issue bonds or whatever. So there are investment decisions and financing decisions. I'm going to limit myself to presenting these two facets when you're running a business. There are several other facets which, in the limited 1.5 hours that we have, I don't have the time to go into. In fact, yesterday, Gopi sent me a big list of things that participants might be interested in discussing. I replied to him saying all of it is out of syllabus, not for this session. Some of those are very interesting questions. I'll be happy to take them in a later session if you so desire. Now, this time value of money is ill understood. And that's why I spend a lot of time in several forums trying to clarify in a very easy to understand way what this whole concept is and why it is so important, so that we can make better informed decisions to invest our money in projects, or even in the equity stock markets, in taking housing loan, in planning your pension. This concept is all pervasive. It starts with a very simple idea that we all learned when we were in middle school or senior school, which is the concept of computing simple interest, which our teacher told us is PTR by 100 or PNR by 100. So if you have 100 rupees in your hand and you want to invest it for a period of 2 years at an interest rate of 10%, if you simple interest, you will get 10 rupees every year, which is 10% of 100 into 2 will be 20. On the other hand, if you use the principle of compound interest, again, going back to first principles, P into 1 plus R to the power of T, P is 100, 1 plus R, which is 10%, to the power of T, here it's equal to 2, so you will get 121. Because there is interest on interest. I mean, we learned this by rote. We must have done tens of problems in our school, and the teachers made sure we got it by rote. Unfortunately, at that time, we didn't realize it's the founding principle of finance rests on this principle of compounding, which is the amount equal to principal into 1 plus R to the power of T. What I've tried to do here is rewrite that formula as P equal to A divided by 1 plus R to the power of T. This is the basic. And I've replaced the word P, and this is what becomes important in the world of finance. P is the present value, A is the future value, divided by 1 plus R to the power of T. Now, remember, in a business, when you want to make an investment, you have to look at how much do I have to invest, which is in time zero. Today I have to invest, and I'm going to get some cash flows into the future every year. Year 1, year 2, year 3, year 4. And then probably at the end of year 5, I will shut down the business or sell all the plant and machinery and land and building and salvage value, recover the money. This is typically what most business decisions are about. And you want to make sure you have made money in the real sense. In the real sense. Let me explain to you what that is. So I've taken a small example here. Today is time zero. I'm going to invest 100 crores. Year 1, this investment of 100 crores in land, building, plant, machinery, etc., will give me a return, a net cash flow of 15. That means net of all your sales revenue, net of all costs, it gives you a return of 15. I'm going to use the word free cash flows. That means what is left after you have met all your expenses. Sales revenue minus all your expenses, minus a few other items, which will become clearer as we go forward. So I made 15 rupees in the first year, 15 crores, 20 crores in the second year, which is my net cash flow, 25 in the third year. And in the third year, at the end of the third year, I'm also selling all the plant machinery, land building, and winding down the business. So I get a salvage value of 45. So if you look at these, if you just add them up, it might appear that it's a good investment because you're 5 crores in the money based on these cash flows. You're 5 crores in the money based on these cash flows. Because minus 100, which is what I invested up front, 15 plus 20 plus 25 plus 45 adds up to 105. So you type invested 100, I got 105. Boy, I made money, $5, 5 crores at the end of the third year. That's where the fallacy is, because you're not comparing, as they say in English, you're not comparing apple for apple. You are investing 100 rupees today, 100 crores today, you're getting 15 crores next year, 20 crores next year, 25 crores year after, 45 crores in the third year. Now, you have to bring all of them as equivalent to this. In other words, what is this 15 crore worth today? You're going to realize it 1 year later. What is it worth today? 20 crores, you're going to realize 2 years from now. What is it worth today? 25 crores, 3 years from now. What is it worth today? 45 crores salvage value, 3 years from now. What is it worth today? Now, how do we do that? That's what I've tried to illustrate here. And this is where the same formula is used. Minus 100, that's today, 1 plus 10% to the power of 0. So it remains 100. What is important is if you take this 15, you're going to realize it 1 year from now, 15 divided by 1 plus 10% to the power of 1, which is actually only 13.64. So what you're realizing, 15 crores next year, in today's terms, it's 13.64. What you're realizing 2 years from now is 20 divided by 1 plus 10% to the power of 2, which is only 16.53. Or if you work reverse, 16.53 crores today, 2 years from now at 10% will be worth 2 crores, 20 crores. So you have to bring everything down to present value. That's what we call the present value of the future cash flows. My future cash flows are 15, 20, 25, 45. I brought all of them down to present value. And the total, if you add up the totals now, it is minus 17.24. If you didn't use time value of money, you thought you made $5. But when you use time value of money, equalize all of them to today, you're getting minus 17.24. In other words, what we're saying is, we have invested 100 crores today. We realize 15, 20, 25, 45, which if you compute it to present value, it is adding up to only 82.76. So you have actually made a loss in this investment in present value terms. In other words, the net present value is negative, minus 17.24. So common sense tells you, don't get into this business because on present value terms, you're making a loss of 17.24. Now, I've expressed this mathematically. This is a formula that you will find very often used It's the same formula that we use when we calculate EMIs, when we calculate our pension planning, everything. This is as important a formula in finance as a plus b whole squared equal to a squared plus b squared plus 2ab, or square of the hypotenuse is equal to the sum of the squares of the other two sides in a right angle triangle. I mean, these are, we learn by rote. Finance people know this by rote. The net present value is the sum of all the cash flows divided by T is the time period, 5 years, 10 years, 15 years. I is the interest rate. We will use the word discount rate as we go forward. I'll explain that to you. And cash flows every year, which is 15, 20, 25, 45, etc. So the I in this problem, I have assumed it to be 10%. The T is 3 years, and I get a net present value of minus 17.24. And the rule of thumb is any project that gives you a negative NPV, you should not undertake that project. Now, I put the same thing down transposed it as 100, 15, 20, 25, 45. The same thing that we saw earlier. The total works out to minus 17.24. NPV is negative. Should we go ahead with that project or not? The answer is no. Now, what I'm going to do is take a small problem. This is a very simple example to illustrate the concept of net present value. I'm going to take a small problem and take you through it and take you through all the complexities in it. So just give me a moment. Let me bring up that problem. I've taken a very simple example, and as we go through, by the end of the 90 minutes, we would have seen a far more sophisticated example of this. Here's a simple case for a time value of money and net present value. Yeah, somebody has a question?
No.
Can I go ahead?
Yes.
Please go ahead, sir.
Yeah. I've taken a very oversimplified example. We sophisticated as we go forward. Chennai Express Shipping Lines, sorry, I got the acronym wrong, CESL, is considering purchasing a new bulk carrier, that's a ship, cargo ship, for, forget about the correctness of the numbers, it's a classroom example, for 14 crores. Now, they want to invest 14 crores right up front today to buy the ship. The forecasted revenues are 6 crores a year, and all the costs put together is 4 crores a year. So the net cash flow every year is 6 minus 4, which is 2 crores. Then at the end of the 5th year, there is a refit cost of 2 crores. That means there has got to be an overhaul of the ship. And at the end of the 10th year also, there is a 2 crores involved. After 15 years, the ship is expected to be sold for scrap value of 3 crores. So we buy a ship for 14 crores. We run it for 15 years. At the end of the 15 years, so 14 crores is a cash outflow for me. Now, today, I'm buying the ship. 15 years from now, I'm going to scrap the ship, and the scrap value is 3 crores. That's a cash inflow. 14 crores at time 0, cash outflow. 3 crores, cash inflow at the end of year 15. In between, I'm putting that ship to use. It's an asset, and I'm putting it to use. 6 crores every year is the revenue I generate by flying the ship on the high seas with cargo, and I earn revenue, and I have operating costs of 4 crores. So in this very simple example, my net cash flow every year is 2 crores. To begin with, the ship is expected to be 100% equity financed. That means the promoters of CESL will invest in this ship. They are willing to put 14 crores to buy this ship. They're not taking a loan. They're not doing anything. We will see the loan complication a little later. And they are expecting, please remember this, gentlemen, this is something we forget when we make these investments. You are expecting a return of 12%. You do this when you make investments in your personal life. When you're putting in a mutual fund, mentally you're telling yourself, I should get a return of 12%. When you're investing in an equity stock of, let us say, L&T, you're saying, I expect a return of at least 12 to 14%. When I put it in a bank deposit, I'm expecting a return of 8%. the difference between the investment in the financial markets and the bank. As you know, in the bank, it's a guaranteed return. In the financial markets, it is a expected return. If you don't make that kind of returns that you expect, you probably end up selling that share because it's not giving you the return that you expected. Same way, equity investors, when they put the money into a company, even if it is their own company, please remember this family which is running this company is taking 14 crores of its money and putting it into the business. Now, if they don't put the money in this business of buying the share, they would have invested it somewhere. They would have got they're getting a return of 12% on that. Wherever they invest, say mutual fund, they're going to get a return of 12%. Now they have foregone that investment and instead invested in this ship. They have foregone an investment that would have given them a return of 12%. Instead, they have invested in the ship. So the investor, in this case, the promoters, will be happy only if this alternate investment they've chosen will give them a return of equivalent 12%, what they've forgone. That is why this is called the opportunity cost. This 14 crores they have invested in the ship instead of investing probably in mutual funds, and they are expecting at least 12%. He bought the ship because he believes that he will earn more than 12%. But he should get a minimum of 12%. Otherwise, he's made a bad investment. He would rather have continue to invest the money in the mutual funds or equity stock markets. Now, this is where the complexity arises. Are you taking a risk? Of course you are. Because the 14%, if you put in a bank deposit, guaranteed 8%. If you put the 14 crores in a mutual fund, you may not get 12, but you may get 11, you may get 13, depending on how the markets move. But by God, you put this 14 crores in buying a ship, you could lose the entire 14 crores. The risk is higher. In other words, whenever you make investment decisions, the risk is much higher. And therefore, if I was the promoter of this company, I would say, hey, I need a minimum of 12%, but I know how to run this business so that I can get greater than 12%. Now, if I didn't have that benchmark, I shouldn't be in the business of buying the ship and trying to run it. Okay? I hope the concept is understood of opportunity cost, what I have forgone. In fact, yesterday, I think when I was talking to Gopi, I mentioned this incidentally. No, I'll come to that later when we talk about housing loans. Chennai Express has engaged you as a financial consultant to help them decide if the investment of 14 crores is worthwhile. Now remember, you make investment decision not after you make the investment, but before you make the investment. In other words, you have to project all your cash flows for whatever time period you're looking at and decide whether it is worthwhile or not. Now, the company is not able to take this decision, so they have appointed you as a consultant. What would be your advice to them? The advice is one line. Go ahead and buy the ship at 14 crores with your money, which you are expecting a return of 12%, or abandon the project and keep the money invested in wherever it is, mutual funds maybe, right? Now, let me put this in the same framework as what we saw earlier. So I hope the problem is clear. I'm going to, I won't shut this. I'll keep this because I may have to bring it up later. So let me go back to yeah. I'm going to present the same thing in a format that we saw earlier. Now, annual net revenue. So initial cash outflow is minus 14. Every year, remember 6 crores is the revenue, 4 crores is the operating expense. So 2 crores, 2 crores, 2 crores every year. In year 5, you have a refit charge, which is a cash outflow. All these are net cash inflows. Again, for 5 years, you have a cash outflow. 10th year, you have another 2 crores going out, and then 2, 2, 2 again. End of the 15th year, you get another 3 crores. So all of this is your actual cash flows. Now, if you add this up, it will look extremely interesting. But what you don't realize is 2 crores realized in the year 15, present value, that means what it is worth today is only 37 lakhs. You're realizing 2 crores 15 years from now. But in present value terms, it's only 37. Or in other words, if you take 37 and invest it at 12%, it will become 2 crores in year 15. So what cash flow you are projecting in year 15 will be worth present value terms only 0.37. So what I've done in each of these columns is at time 0, we have invested 14 crores, which is cash outflow. At the end of year 1, cash inflow net of 2 crores because the ship is in the high seas, it's generating revenue, we are incurring costs. And the net cash flow for us is positive 2, which 2 crores divided by 1 plus 12% to the power of 1, because it's 1 year later. Now, if you take the 5th year, it will be 2 crores divided by 1 plus 10% to the power of 5. So you're realizing it 5 years later. So today it is worth only 1.13 crores. What you realize next year is worth 1.79 crores today. What you will realize 2 crores 5 years from now is only 1.13 crores. So the farther the cash flows, the lower will be the present value. And then you add all the present values. In other words, another way of interpreting this is you're investing 14 crores today, and what you're realizing in present value terms on the 2 crores every year is $12.39 crores. You are investing 14 crores today. All your future cash flows, if you recompute it to what will be worth today, it is working out to only 12.39 crores. In other words, in present value terms, it is a bad investment. 14 crores invested today, realizing 12.39 crores over a 15-year period, all computed to present value. The net present value is 14 minus 12.39, which is minus 1.61. On the other hand, if you look at how much revenue they have realized, it looks fantastic. They have realized 26 crores in revenue year after year after. So if you take the sum of all the revenues realized over the 15-year period, it is 26 crores. But by God, if you take the present value of all those future cash flows, it is only 12.39. So on a net present value basis, it's 1.61. In other words, what this is saying is, boss, you're investing 14 crores today, and that is giving you an effective return in present value terms of only 12.39. You are out of the money by 1.61 crores. Net present value is negative. Do not go ahead with this project. This is a very simple arithmetic. Because remember, you're making the investment today. And remember, you've still not bought the ship. You're debating whether to buy the ship or not. So what should you get most accurately? The future cash flows. And then you do some sensitivity analysis. What if I don't realize 2 crores? And we'll do all of those what if analysis. I've listed a whole series of them here. As things stand, you'll go back to the management, and will you tell them to go ahead with this investment or not? Remember, you're working as a consultant. Can someone give me the answer to that? Will you go ahead with this investment or what will you go and tell the bosses, the owners of the company? Yeah, go ahead.
Sir, one thing, can we, do we added the scrap value also in this?
Yes, I have 3 crores. Just 1 minute. 3 crores, no? Last
4 crores, 2 crores for 5th year and 10th year, 2 crores, 4 crores has been added. That is why
that is minus.
Minus. That's why it is 30 minus 4, 26.
Yeah. Okay. And that 26 makes no sense really to us because it is over different points in time. You compute everything to present value, it is only 12.39, which is the sum of this column. And therefore, net, you are out of the money. That is why when the golden rule in investment decisions, do not invest if it is NPV. NPV is negative. That means what you're spending today versus what you're realizing as future cash flows at present value, the sum is negative, therefore don't go ahead with the investment. Now you go to the bosses and tell them, to go to the owners and tell them, boss, this is not going to work here. This is hugely NPV negative, forget it, not worth it. But those guys turn around and tell you, no, we are very emotionally attached to this. We want to buy that ship at 14 crores. We don't understand all this net present value and all this gobbledygook. You tell us what we should do to make it viable. That means, in our parlance, how to make it NPV positive. Now, can any of you tell me, since most of you are in business, and now we are consultants, we have come back to the drawing board. We have a mandate, make it positive. We don't care. We don't understand all this NPV. We have to invest, make it viable. Another way of putting it is, make it NPV positive. Now, what are the alternatives, gentlemen, you have to make it NPV positive? What are the alternatives you have? What can you do to make it NPV positive?
I'm Dhanashekaran. Reduce the expenses or try to generate more revenue.
Okay.
Is it okay?
This is classic, isn't it? Whenever we have a problem, in other words, what you're saying is make this 2 into something more. Correct? So let me go back into this. Good point you made.
Sir, can we go for a cross check regarding the cost of acquisition of this particular ship? Whether a lower cost option is available for this particular
Very good.
venture or not?
Right. There you go. Pay less to buy the ship. That's one of the options I've given. The option told to me earlier was increase revenue, reduce cost. I'll come to the pay less to buy the ship in just a minute. Increase revenue, reduce cost. Gentlemen, most of you in this audience run a business. The reality in business is revenue always reduces, cost always increases. And now here we are as consultants going and telling the promoters, increase your revenue, reduce your cost. Immediate reaction will be, no, that's difficult. It's a very competitive market. You don't understand. Our labor costs are going up. The paradox of running a business is our objective is to increase revenue. Unfortunately, for competitive reasons, margins are being eroded, revenue is falling. Because of inflation, because of turnover of labor, our costs are going up. So the opposite always happens. This is the paradox of running a business. I'll put a meaningful response to this in just a few minutes from now. Someone said pay less to buy the ship. Correct? That was the second suggestion. Let's take it. Please remember, the guy from whom you're buying the ship, he's not an idiot, You go and tell him, boss, reduce the price. What is he going to say? Just give me an answer. If you are the seller of the ship, what do you tell him? We, the promoters of Chennai Express, have come to you, or the consultants of Chennai Express come and say, boss, 14 crores, please reduce. What will be your reaction? You're selling the ship to Chennai Express.
No, he must have already his NPV. He must have He must have already calculated his IRR or NPV.
His NPV, IRR, and he's now coming and telling 14 crores. He didn't come up with the figure of 14 crores out of the blue.
Yes.
He has done his own math. So now see, this is the beauty of a methodology like this. You're speaking with data and you're respectful of the arguments that the opposing party, in this case, the seller of the ship, will present to you. Both of us are speaking with data. Go back and look at your own lives. Most often, if our data is incomplete, our decisions will be not sound. So now I'm going to, very good point you raised. Now what I'm going to say is, that guy has also done some similar arithmetic. So he's going to say, okay, you argue with him, both of you sit for one day and discuss and debate. And then he says, all right, I will sell you the ship for 13. You come to an agreement. And you pay me 50 lakhs extra when your refit charges. So you try to fool him into thinking he is still getting, earlier also he was getting 14 plus 2 plus, sorry. $14 plus 2 plus 2. So you tell the guy, boss, pehle aapko, you're getting 16 in before. Now also I'm giving you 16, 13 plus, 14 plus 2, 16 plus 2, 18. Now please take 13 plus 2.5 plus 2, which also adds up to 18. What is the downside to this? If he's a smart seller, what will he tell you? Time value of money. Think about it.
He will not agree.
Why?
The net value will go down. No?
Exactly. Minus 13 minus 2.5 minus 2.5 is not the same as minus 14 minus 2 minus 2. This is where negotiations begin. Remember, the seller is also asking to sell the ship, and he wants to minimize the reduction in his profits. And as someone rightly pointed out, he's also probably sitting with a spreadsheet like this. So let's say finally we agree that it will be minus 13.5. And this will be minus 2.25 and minus 2.25. Now you are doing this in real time. Remember earlier the negative was minus 1.61 crores. Not bad. For negotiating the price, it has come down to minus 1.33. So we have improved, but we are nowhere near zero, boss. Our objective is NPV equal to 0. So we have looked at pay less for the ship, and we have come up with some solution which may or may not be acceptable, but the seller of the ship says, this is the best I can offer. Okay, now, what are the other options I've got here? Increase revenue, reduce cost, I'll come to in a minute. Okay. Increase the salvage value of the ship. Is there a possibility? So instead of getting 3 crores at the end of 15 years, you're projecting, right? Let's make it 4 crores. Let's say we'll be able to sell the ship at 4 crores. Will it have a favorable impact on our calculation? If I put 4 crores here, it has come down to minus 1.15. So from minus 1.33, it has come down to minus 1.15. But this is a good idea. Think of it as a business person. To just try and justify NPV positive by increasing the scrap value of the asset at the end of the project. Is it a good idea or a bad idea?
Sir, I think it is a bad idea, because if you try to increase the scrap value, you have to do a lot of maintenance. Essentially, you are losing on maintenance.
Not only that, your point is absolutely valid. The 15 years from now, we don't know what the industry is going to look like, you know. Maybe air cargo will be cheaper than ship. Therefore, the whole industry might shift. How do we know what's going to happen 15 years from now? The lesson here is, don't justify your project by increased cash flows at the tail end of the project. I hope you understand what I'm saying. Tail end project, whatever you get is bonus. You should, if you're a clever businessman, you will try and maximize everything in the first 4 to 5 years of your investment. Okay, so while the salvage value increase looks like a good idea, it is not such a good idea, because you are looking at cash flows 15 years away. Now, pay less to buy the ship, we have looked at. Salvage value increase, we have looked at. Now, let's look at sell early. Okay, sell early. You know what I mean? Don't keep the ship for 15 years. Sell it at the end of 10 years. Sell it at the end of 5 years. Look at that alternatives. So we don't have to go to the seller of the ship. We just say, if I sell the ship, in other words, at the end of 5 years, I'm not going to incur the refit cost of minus 2.25. Instead, I'm going to sell the ship at the end of 5 years. Okay. How much do you think we'll be able to sell the ship for at the end of 5 years? Remember, we paid 13.5 to begin with, and whoever is buying the ship from you, you got to tell him, boss, you will, when you buy the ship from me, incur a cost of minus 2. You will have to incur 2.25 to refurbish the ship. I'm selling it to you without refurbishing. If you want continued support from the vendor of the ship, seller of the ship, you need to spend 2.25 crores. So how much do you think realistically he will quote to buy your ship? Because remember, he has the cash outflows 2.25 crores. They are honest businessmen. We have told him upfront. It needs maintenance. 5 saal ke baad, minus 2.25 crores is what you will incur. At what price do you think the guy will buy it? He'll run it for 5 years.
9 crores or 8 crores?
9 crores or 8 crores. Now think about it, Let me take your 9 crores. He's paying you 9 crores, paying Chennai Express 9 crores, plus he is going to incur 2.25 crores, that is 11.25 crores. Chennai Express bought the ship 5 years ago at 13.5. And now they're selling it at 9 crores, but you're a smart buyer. No, you know that you have to incur 2.25. So your total cost is 11.25. Will you buy the ship at that price? If you are the buyer?
No.
Because your total cash outflow is 9 crores plus 2.25 crores, which is the refit cost. 11.25. Yes or no?
No.
There you go. You see, now that we have a spreadsheet like this in front of us, we were able to answer questions without reacting emotionally. Because the numbers speak for themselves. But let me say, I will manage to sell the ship for 8 crores. I'm just taking an arbitrary number. Okay? 8 crores. This is a what if, you can do what if analysis. So, this is what we would have incurred. All these cash flows is what we would have got. So 1, 2, 3, 4, 5 years of 2 crores revenue, 8 crores we sell the ship for. Equal to, so let's see, in minus 1.75. If you sold it at the end of 15 years, it was better than selling it at the end of 5 years. So this is out. I just wanted to show you the results of selling early. You can do the same thing. I'll be sending you this spreadsheet. If we did it at the end of 10 years, what will it be? What will be the price of the ship? What will be the cost you will incur? And then you do the same analysis. Is it NPV positive or negative? So selling early doesn't seem to work very well. Pay less to buy the ship. Yes, we have included, but it didn't make it NPV positive. Let me go back and change this. Right, we brought it back to minus 1.33. Let's look at increase revenue, reduce cost. We hate this, If you're the boss, you want to increase revenue, reduce cost. But if you're the subordinate, you won't have the guts to tell the boss. The reality in the outside world is revenue is always decreasing, cost is always increasing. So I can't go and tell him, okay, let's make 2.25 all the 15 years. Or 2.5 all the 15 years. You can easily make it NPV positive. But is it practical? It is not. So I as a consultant, or we as consultants would have to come up with a recommendation that is more saleable to our client. And what I think would be a saleable idea, in the interest of time, I am giving you this suggestion myself. In normal course, I would have elicited more responses from the participants. Let's say for the first 3 years. First 3 years. Third and fourth year. So the near-term cash flows, ladies and gentlemen, please bear this in mind. You can more realistically estimate the cash flows, the net cash flows in the early years, not in the later years. So I don't know whether I will be able to make 2 crores in year 11, 12, 13, 14, 15. It may be less. So I want to justify the project in as short a time frame as possible. So I got a warranty from the seller of the ship so that my maintenance costs are lower. I can operate with fewer people because it's a new ship. I can load cargo and do more, so my revenues are higher. Higher revenues, lower operating costs in the first 4 or 5 years. I can make net revenue higher for the first 5 years. And what does that give me? This project has already become NPV positive. In other words, whenever you're doing a project, the initial cash flows in the first 3 to 5 years is very important. Let me give you an example. You know, I did a project on similar lines. I did a training program for a group of people in Hindustan Unilever. Now, Hindustan Unilever is in the FMCG business, right? Fast moving consumer goods. It's not like running a ship or an airplane or something. In 3 years, the product becomes obsolete. You have to come up with a new variant. So the rule of thumb in Hindustan Unilever is, if your new product is not NPV positive in 3 to 5 years, the product doesn't take off. They won't invest any money in it. Nothing at all. This is the rule. Whereas you go to a steel plant, it can run for 30 years. Incrementally, you have to refurbish it. You have to, maintenance costs will go up, all sorts of things. But it's still producing steel. It's still producing steel. What is this? Yeah. So I hope you understand. All I did was increased my cash flows for the first 5 years. I don't bother about the rest of it. In fact, I even reduce it in the later years, and bang, it's become NPV positive. So we increase revenue, reduce costs only for the first 5 years. We didn't touch the salvage value because it is too far into the horizon. We pay less to buy the ship. Yes, we have included that. And we sell early. It didn't work out. So with 2 of these 5 alternatives, pay less to buy the ship by deferring some of the initial costs onto the refitment, and increase revenue, reduce cost only for the first 5 years. We have converted this into an NPV positive project. So you go back to the bosses and say, well, this is what we've done. Can we go ahead? Now comes the next question. Suddenly they develop cold feet. And they say, abhi to ho gaya. It is NPV positive. Now remember, there is some concept called IRR. IRR. Now let me restore it to all the original values, just to illustrate what it is IRR. I'm restoring it to the original value, everything. Where is the difference? Two.
It's -2, not -2.5.
Oh, it's -2. Thank you. Thank you for spotting that. Yeah, I knew something was not right. I've got the original -1.61, the unviable state. One way of interpreting this is, effectively, we are, somebody raise your hand. Please go ahead, ask your question. Hello? Go ahead, ask your question. Or can I proceed? Now, what we're basically saying is, we are expecting a return of 12% by putting this 14 crore to buy the ship. We are the promoters to this company. Actually, this project is giving me only 9.9%. The internal rate of return is 9.9%. What is this 9.9%? It is that rate when the NPV equal to 0. So when I plugged in 9.9 here, this has become 0. So a simple English language interpretation of this is, I am expecting a return of 12%, but this project with these cash flows is giving me a return of only 9.9%. I shouldn't go ahead with this project. In other words, if the IRR is less than the expected return of 12%, which is what it is, I should not go ahead with this project. So it is much easier to understand than to say NPV is negative 1.61. Doesn't make much sense. On the other hand, if I told you, I told the promoters, we, the consultants, told these promoters, sir, your return on this project is only 9.9% against your investment expectation of 12%, shouldn't go ahead with this project. But if you made all those changes that we said you should, then let me reinstate all the values. .17, that means you will be getting a return that is equal to or greater than 12. So this is positive. Now let me go to the next page to show you that. I'm taking this forward a little bit. The promoter is still not happy. They develop cold feet. And they ask you, sir, as a consultant, can you tell us, instead of putting the entire 14 crores, can we take a loan from the bank? Say 7 crores, bank gives loan, 7 crores, we invest. What does the scene look like? Debt equity ratio is 1:1. I hope you understood the new scenario I'm painting. So far, it was all our money, promoters' money. Now we are saying 50% loan, 50% our money. So here, percentage equity is what we are investing is 50%. Debt is 50%. So in other words, 7 crores equity our paisa, 7 crores debt which is given to me by the bank at 10%. Bank is giving me at 10%. I am expecting a return of 12%. So my weighted average cost of capital. Capital is what? 14 crores what we need. Equity 7 crores. Debt 7 crores. Equity 12% expected return. Debt is 10% contracted return by the bank. They say we will give you 7 crores at 10%. Please mortgage the ship to us. So the guy is very safe, you know. The lender is very safe. He says 14 crores worth of assets, the ship, you mortgage to us. We will give you a loan of 7 crores. What that does is, earlier it was 12%. Remember, this was 12%. So when every 100% was equity, which is what we saw in the previous example, the cost of capital was 12% because the entire 14 crores was at 12%. Now only 50% is at 12% and 50% is at 10%. So my cost of capital, cost of the 14 crores is come down to 11%. Now, will this have a favorable impact on the net NPV and IRR calculations? Can someone tell me?
Obviously, it will increase. You'll get a better net profit value.
You get a much better IRR. In fact, the IRR has gone up to 11.85%. Your NPV has gone to 0.65 and your IRR has gone to 11.85. So just to, by the way, in Excel spreadsheet, there is a macro called IRR, equal to IRR, open bracket. You fill in the parameter, it will give you the answer. That's how I got this answer. So if I put 11.85%, this becomes 0. So simply by 2 or 3 things which I did. One is, first 5 years cash flows we changed. Second is, we've gone now said we'll take 50% loan from the bank. The bank is willing to give it to us at 10%. If we mortgage the ship to them, they're willing to take the risk. My project has become extremely viable and I'm getting a return of 11.85%. It's a no-brainer now. Go ahead with the decision to buy the ship. So we started off with saying IRR is only 9.9%. Now we have got 11.85%. Johnny Varghese have raised your hand. Please go ahead.
Sir, at the present condition, will the bank be ready for giving us this much of amount for 10%?
Okay. That's something you have to negotiate. This is a classroom example. I am assuming they will give it at 10%. I always, please remember, yeah, they may tell you 11%, they may tell you 11.5%. That is where you have to negotiate with the bank. All I'm telling you is the cost of debt is contracted. So if the bank tells you we will give it to you at 10.5%, you must, no matter what, pay them the 10.5%. Whether you make a profit, whether you make a loss, they don't give a damn. You have to pay them 10.5%. Only the residue goes to the equity shareholders. That means PAT, profit after tax, whatever is remaining, bach gaya, that is for the equity shareholders. So it all boils down to how well you can negotiate with the bank. And if you don't have the hotspot to negotiate, tough. That's why you have to put your own money. This is where business becomes very interesting. So let's say you go back to the bank, and as you said, just as an example, they want 11%, not 12. Straight away it shoots up to 11.5. You're still okay to pay at 11.5 because your project is still NPV positive. Your project is still NPV positive. You might decide, okay, I'm willing to pay 0.5% more. Chalo, aage badho. Because my project is NPV positive and my IRR will be 11.85. I'm willing to pay the extra. See, the advantage with this NPV spreadsheets, it helps you take the decision then and there. You don't have to, in fact, you can on your own work out and say, even if they charge 11.75%, I'm still okay. So when you go to negotiate with the bank, you tell yourself, if they're not going to give it 10%, worst case, I can go up to 11.75. And I will keep it as close to 10% as possible. So when you're negotiating with the bank, you've got a range within which to operate. I hope, Varghese, I have answered your question.
Yes, sir.
Now, the problem when you're dealing with bankers, and I've been in the banking industry for 20 years, some of the CFOs of these large companies do all this homework. When they come to the negotiating table, they know what is the floor they want to ask for, which is what they want, and what is the cap. That means how much are they willing to move up. If you don't have all this data, the guy could take you to the cleaner. For example, if you didn't know that you are expecting, if you're not sure what your own expected return is 12%, and the guy quotes you 13%, you're finished, man. The project is gone. But you're very interested on this project. How do you negotiate? What NPV and IRR methodologies give you is the ability to negotiate with data. And the bankers will not take you for a ride if they know that you got your fundas right, you understand the time value of money, and you got a spreadsheet from where you're negotiating. Don't ever go to a banker, sir, please reduce the interest rate. He will ride you. I hope you understand what I'm saying. It is like, a student coming to me saying, sir, please increase my marks. On what basis? The guy says in question number 5, you have given me 6 marks. You have given another guy who got the same answer, you have given him 8 marks. Why did you give me 6? Why did you give me 8? He's speaking with data. That's all I'm saying. You must have your data and your spreadsheet so you can do a what-if analysis quickly and be able to say what should be the optimum rate that you will accept. Yeah. Right. Now, there is one issue here. The issue here is, and I will close this discussion with this and then we will move on to another topic. If you notice, I have not repaid the principal. I have only accounted for the interest. I have not repaid the principal. There's a principal repayment also involved. This project is for 15 years. Now, you don't want to take a loan for that long. You want to take a loan only for, let's say, 10 years. You want to be able to repay the loan at the end of 10 years, which is what I have done in the next one. All right. So we go to the bank and they give me 10%. Let's say they agree to give me the loan at 10%, and for a period of 10 years, every month, every year, you have to pay 10% of the principal plus the interest. So in the first year, my principal repayment is 70 lakhs and my interest at 10% on this amount will be, sorry, what is your question, sir? Somebody raised your hand.
Sir, good morning, sir. Sir, this regarding this IRR, can you show the calculations, sir, how it is estimated?
Okay. Let
Sir,
me.
then one more question is also there, sir. Is it like the 5th year, why the revenue is not added, sir? Only the refit charges is added. Any
No,
specific?
revenue there. Revenue there's
-2, it is added, sir, but the revenue also to be, no, sir, that
the line above. Net revenue is 2 crores. Refit charges is -2 crores. 2 lines are there. For year 5,
understood, sir. Understood, sir.
I didn't club the two together.
Okay, okay. So then the third question is it okay to estimate only IRR? It seems to be easier for us. So for me actually, instead of that is NPV, is it okay or?
In fact, you go to a company like L&T,
Okay.
and you present your proposal, you're giving a proposal to them for investing 10,000 crores. These are big numbers. And these are usually business unit heads. And in fact, you know what the CFO will say? Your hurdle rate is 13%. Since you raised this question, what he's basically saying is, if your IRR is 13% or more, we will approve this project, otherwise no. He has done his homework. So you have built your spreadsheet. This is the capital cost, this is all my cash flows, revenue. So typically, what happens, when you go to a large corporation like that, how do I take this damn thing out? I've forgotten my. Yeah, there you go. Typically, when you go there, they will just tell you hurdle rate, they call it. Hurdle rate means unless your project is giving an internal rate of return of the hurdle rate, which is equal to 13%, your project is not going through. Or there are some other situations where L&T has got only 10,000 crores to invest in as capital investment. There are 3 projects fighting with each other. You are the CFO. To which project will you allocate the 10,000 crores? 3 projects, each one requiring a capital investment of 10,000 crores. You can only invest in one of them because the total capital available to you is only 10,000 crores. Which project will you give the go-ahead?
Which gives maximum IRR.
Exactly. One line answer, no? Whichever is giving me the highest IRR. So let's take it to the next logical step. I am a business unit head and I know how this damn thing works. So what I will do is, to get it the highest IRR, I will bump up my revenues, I will reduce my cost in my cash flows, because I know my IRR has to be the highest. So when I increase revenue, reduce cost, it will become the highest. You're the CFO. How are you going to track this? So, after all, it's human beings. Please understand. I want this project at any cost. Let me screw the system. Let me increase my revenues, reduce cost. Don't we do that? When you present it to the banker, you always present a very positive picture. Let the banker find out. So here, let the CFO find out. Which is why, people like me get paid a huge sum of money to evaluate the cash flows. I will show you the cash flow of one of the projects that I evaluated recently. It's confusing. Huh? I won't go into the details, but I'll just tell you what we are seeing is a very simple spreadsheet. I'll show you a very complicated spreadsheet.
So I have another question. In year 5, you said the retrofitting of 2.5.
Just 1 minute. Let me. Yeah. You see, this is the kind of spreadsheets you'll find. A jar number, 15 years cash flow projection, item wise, what is the revenue, item wise, what is the cost, and then you have to work through it. And companies and banks as well call people like me as independent consultants and say, sir, can you tell us whether there's any exaggeration in this? For example, in a toll road project, one of the big risks is I will overstate my toll collection. I want to borrow from the bank. So higher revenue is what? Higher toll collection. I will reduce my maintenance cost. We should have the expertise to be able to go back and tell this guy, this is not going to work. So I don't tell him it's not going to work. I'll tell him, assume your total collection will be 10% lower. Is it still NPV positive? What is the IRR looking like? I hope you understood the point I'm trying to explain. Okay? Yeah, go ahead. Somebody had a question.
Yeah, in the year 5, we have a retrofit retrofit happens. At that point in time, there will be a downtime, so the revenue will not be the same of projected of 2.
Absolutely, you're right. I've not gone into that level of sophistication in this classroom example, but yes, you're right. It might not be 2 crores that year. It might only be 1.75 or 1.65 crores, whatever.
Thank you,
Because
sir.
for the period of the downtime, there won't be revenue. Yeah, you have to adjust the spreadsheet for all of that.
Sir, this
I haven't done
IRR estimation, sir.
Yeah, IRR estimation. If you, it's a macro in Excel. Once you get all these calculations, no, you just have to type in equal to IRR open brackets, and you go in here. It will tell you what are the values you have to fill up. I'm not going to go into that. In fact, the syntax and how to fill it up, everything is given. Can you see that on the right side? What are the values? There are 3 values. One is how many years. Second is you have to refer to these cash flows from this column to this column over the 15-year period. It will calculate the IRR. Because you go back to that original thing that we saw. Why they're not coming up? See, if you really look at this formula, CFT is the cash flow every year. I is the interest rate. T is the time period. Now, when you calculate IRR, NPV should be equal to 0. So 0 equal to all of this plus I. The only variable will be I. Find out the value of I. That's what the macro does. Give all the cash flows in our example for the 15 years. And N equal to 15. The cash flow for the 15 years. NPV equal to 0. I will be calculated. How many variables are there? 1, 2, 3, 4. You give any 3 variables, it will calculate the 4th. That's all it does. So the I, when it is equal to IRR, the left side is assumed to be 0. If the I is not equal to 0, NPV is not equal to 0, you'll have some negative value or positive value. Is that clear? There are only 4 variables in this time value formula. Net present value, annual cash flows, the discount rate, and the period, number of years. Any 3 out of this is given, the 4th one it will calculate. Have I answered your question?
If you don't mind, if I can pitch in, if you allow me to pitch in.
Yeah. Go ahead.
This is Venugopal here.
Go ahead, sir. I can't hear you. I've lost you. Can you hear me?
You proceed, sir. Proceed, sir.
Yeah.
I think by mistake he muted himself. Looks like.
Okay. Okay. I hope you got a reasonable sense of how to do this IRR calculation. It is, to my mind, very fundamental. Net present value equal to 0. What will be the IRR? In this example, it has turned out to be 11.85. One last piece on this, and this is what I was showing when the question was asked. We've taken a loan of 7 lakhs from the bank now, which I didn't show in the previous spreadsheets. And it's going to be repaid at the rate of 70 lakhs per annum for 10 years. And on the diminishing principal, interest will be calculated at 10%. So the total is working out to, in the first year, we have to pay 1.36 crores, 1.33 crores. Will this be a cash outflow or a cash inflow? This last column. We are repaying the loan plus interest over 10 years. So this is money going out from the company. Is that clear? So you will find that in this revised spreadsheet, this is not 14 crores, it's only 7 crores, which is our investment as equity shareholders, as the promoters of this company. 7 crores is given as a loan by the bank, which you have to repay over a 10-year period at 10% interest. So both of these will be cash outflows, which is what I've calculated here. So in the first year, we have to pay the bank 1 crore 36 lakhs 50,000. So if I go here, I've taken it as 1.4, which is an approximation. So although my revenue was, let's take the first year, 2.5, I have to repay 1.4 crores as to the bank as principal plus interest repayment. So my effective cash flow is only 1.1. So you will notice I have reduced the cash flows for the first 10 years. 15 years is the total time period. 5 years it is reduced. And what this does is, because I am putting only 7 crores of my money, the remaining 7 crores is being repaid as interest and principal in the first 10 years. My equity IRR goes up to 12.85. The previous one, my equity IRR was only 11.85. It has gone up to 12.85 because I invested only 7 crores. My risk in the company is now only half. Half the risk is taken by the bank, 7 crores. Half the risk only I am taking. Which is why it is always advisable for banks or for companies, when they're doing a project, first do it as an all equity project. That means you're going to bring in the entire amount of money. Then you look at how much of a loan can I take so that my return to the equity shareholders can be increased. Because now I'm only investing 7 crores, not 14 crores. And the 7 crore loan from the bank is coming at 10%, whereas the shareholders are expecting a return of 12%. So I am putting in the capital 50% of the money, 7 crores, which is now going to cost me only 10%. Which is why this has gone up and the equity IRR has gone up to 12.85%. Now, in the interest of time, I leave this spreadsheet with you. You can go and work on it yourself. I will email it to Gopi. He can forward it to whoever so that you guys can work on it at your own time and try and understand this. Now, that sort of brings me to a close on this segment of the discussion. Somebody had a question? Hello?
Nothing, sir, nothing.
Okay. So this is the repayment table. Every year, principal to be repaid, interest to be repaid. So this is a cash outflow from the company towards the loan that it has taken. The advantage is the loan is being repaid, therefore all these cash flows are reduced. But your initial investment from your pocket is only -7, not -14, which is what it was in the previous case. And therefore you find net equity shareholders stand to benefit if loan is taken. But you know what? How many of you run your business without taking a loan?
Me, I am.
Huh?
I mean, I'm running a business
Sorry, go
on a
ahead.
loan because the bank doesn't help me.
Oh, okay, that's a bad idea. You know what? If you can demonstrate to a bank, in fact, when I was in the banking industry, I used to encourage a lot of the entrepreneurs who come to me. I'm a very rare specimen in the bank. I spend a lot of time with them and say, look, the project you've taken on is wrong, because I used to show them spreadsheets like this and say, this is where you're going wrong. Please do the following so that you can show us that you can, if not wipe out your losses, at least generate positive cash flows. Once you do that, I'm willing to take a bet. I'll give you the money at this interest rate, and then you can turn around your company, because the paradox of money is when you don't need it, lots of guys will come and give you money. When you need it, the banker will just very rare bankers who are willing to help when you need it and your intentions are clear. This brings me to a very interesting reason why bankers don't lend, they back off. Because there are so many borrowers in the country, in every country in the world, who will fit the numbers, make it all look very rosy. The banker is not any the wiser because it's a technical product. And when he's afraid, he's not sure. This guy says he'll give money, he's a very glib talker, I won't give money. Or if he's a very flamboyant banker, he'll say, yeah, boss, I'll give you the money. Both are wrong. In the first case, you're not giving the money because the banker didn't understand the product and the project report, it's wrong. The second case where the flamboyant banker gives money away is bad. The best example is Mr. Vijay Mallya. He is very flamboyant. I was in the banking industry at that time. And I'm proud to say, when the fellow came and asked for money for his Kingfisher Airlines, out of the 14 bankers who were present there, I was the only one who declined. Because I said your cash flows are exaggerated. He didn't like it. He wouldn't even give me an audience after that because I tried to meet him one-on-one and tell him how it must be fixed. He was not keen because his ego is high. He said, there are 13 bankers who are willing to give me money. Who the hell are you to say, no, I don't need you? Okay, thank you very much. 6 years later, when the company went down the chute, every one of those bankers who had lent money had their backs to the wall. Some of them were taken to CVC and CBI and all of those because this guy was a fraud. Now, all the remaining 13 bankers got sold on his sales pitch. You know what is the sales pitch? Sir, in the airline industry, things can't go wrong. It's asset-based lending. You're giving me 100 crores, I'm buying an aircraft with it. If my business doesn't, and I'm buying 10 aircraft, so you're giving me 1,000 crores to buy 10 aircraft. Now, if my business doesn't take off, the aircrafts are mortgaged to you, you can take it back, sell it in the market, recover your loan. Give me 80%, 80 crores loan to buy, 800 crores loan to buy 10 aircrafts of 100 crores each, 1,000 crores. A lot of them said, yeah, it's a good idea, it's all assets, a good asset, it's saleable. Guess what? This guy was a fraud. You know why? Because firstly, his cash flows were not looking good. That's why I said, no, you're all exaggerated. You're assuming others like Indigo and all that will just sit by the side and everybody will want to fly only your airline. No. Just assume 50% only you will be able to, passengers only will be able to get. He knew the minute I started asking these questions, he knew that right questions are being asked, but he had put on blinkers because there were bankers who were willing to lend to him on the basis of what he has said. I hope you understand what I'm trying to do. These are very interesting lessons for business people to learn from. I will just take these two examples, give you my understanding, because in Nirav Modi's investigation, I was remotely involved in it with the Reserve Bank of India. So I will come to that in just a minute. That case is very different to Vijay Mallya. Vijay Mallya started off well. Unfortunately for him, the 2008 crisis happened and his business went topsy-turvy. He could not repay the loans to the bank. When the bank decided to possess the aircraft and sell. Remember, this is how I started. Those are assets that can be sold. Those assets had been mortgaged to some other lender as well. And our banks were not aware of it. So when they tried to enforce the mortgage, they could not because it had been mortgaged to someone else. So it became a legal issue. That's when it turned into a fraud. That is Vijay Mallya, 1. 2, there's a huge lesson we learned from that. This insolvency and bankruptcy code and the setting of the NCLT, etc., happened as a result of this. Let me explain to you the great learning from this. It's got nothing to do with India. Let's take the United States. 4 airlines in the United States. American Airlines, United Airlines, Continental Airlines, US Airways. 4 of the airlines all were in a similar situation of not being able to repay the debt to the banks. So all four of them went to the bankruptcy court in the United States and said to the bankruptcy court in their filing, we are unable to repay the loan, not because our airline is doing badly, but because of external circumstances where revenues have dropped, costs have gone up because of fuel prices. So please give us bankruptcy protection. That means don't let the lenders loose and start taking possession of our aircraft. Remember, in 2008, we didn't have the insolvency and bankruptcy code in India. It was still being politically debated, whereas the US has a very strong bankruptcy code. So the minute this happened, the bankruptcy court told the four airlines, okay, we give you bankruptcy protection. What is the meaning of this bankruptcy protection? We won't allow the lenders to come and breathe down your neck and try to possess your assets. We'll give you breathing time for 18 months. Now, every month you have to come back and tell us what actions you have taken to come out of bankruptcy. What did they do? Every month they would go and the CEO would say, we have these aircrafts given back, so my operating cost is coming down. Unviable routes have been shut down, so my costs are improved even better. And they say this is the progress we are making. Every month, all the four airlines had to give reasons, actions taken. At the end of the 18 months, the bankruptcy court said to the American Airlines and United Airlines, you guys have done a good job. You're out of bankruptcy. Now back to business normal. So lenders will start chasing you. This is already 2010, 2 years gone by. Okay, they came out of bankruptcy. But US Airways and Continental could not come out of bankruptcy because the situation is terrible. So what did the bankruptcy court tell them? Either you become insolvent, that means sell off all your assets, wind down your business, or get acquired by another business. And guess what? Continental was bought out by United Airlines. US Airways was bought out by American Airlines. So Continental in US ceased to exist. US Airways and American bailed these two companies out and industry survived. Why? Because they had a strong bankruptcy code. We did not have. And I still maintain, had there been early intervention, a lot of airlines in this country would have survived. We didn't have that. This is true of several situations. However, in India, the ethical standards of a lot of the promoters is not up to speed. So what they actually do is, I'll show you in this spreadsheet, they put 10% equity and 90% debt. Why? Because cost of debt is always lower. Plus, if the company goes bust, the lender is in trouble, not the promoter. So if you look at all these guys, I don't want to name them because again, it becomes an emotional issue. All these big guys, they took too much debt. Now the question being asked, and I've asked this in several forums, why did the banks close their eyes and lend? Why did we have such a huge NPA problem in this country? It was created by the bankers putting on blinkers when they were lending. They didn't ask the right questions. Ultimately, and this is the point, you could easily do this because the banks were in the public sector. And there were all kinds of underhand dealings, etc., that happened. Loans were given, everybody knew. I don't want to name one or two parties. His equity was 3,000 crores, his borrowings were 30,000 crores. Now, you guys, business people know this. A leverage of 10, debt equity ratio of 10 is unsustainable. And if the economy goes through a bad patch, you won't be able to repay the loan. That's why we had those huge NPA problems. And the government, on behalf of the public sector banks, had to write off 12.5, 13, 14 lakh crores. And they said they're cleaning up the balance sheet. Interestingly, the problem is reappearing again. Okay? Now, the private sector banks, the big ones, Axis Bank, ICICI Bank, the corporate standards, corporate governance standards are much bigger. They did not allow this. They have much better evaluation techniques, methodologies, and therefore they haven't got themselves into as serious a problem as the public sector banks did. Public sector banks have learned their lessons, but they still seem to be committing mistakes. In fact, one of the areas where I put a lot of effort in training the banking system is in improving the credit appraisal skills of a lot of the people in the banking system today. That's a broader side, because they don't know a lot. I mean, most of the bankers don't know NPD. How is he going to evaluate a proposal? Okay. Now, Nirav Modi was 100% fraud. 100% fraud. And let me spend 2 minutes to tell you what he did. There was a guy sitting in Punjab National Bank Swift Center. Normally, what happens is when you open a letter of credit or whatever, you submitted your application in the branch. The branch then processes the letter of credit and advises the recipient, the beneficiary, through what is called a Swift message. The Swift message is passed directly from the branch computer system through the central server, CBS, to the Swift server. Swift server is a third-party software, from where it is sent to the outside world. No intervention. The guy sitting in the Swift center can only hit the button. You had a question?
I would inform her, otherwise she can learn to come and
लाभार्थींना आणि त्यांच्या कुटुंबियांना मोतीबिंदू पडद्याचे विकार.
Okay. There was one. So it's what we call straight-through processing. With bank's CS system, the LC details are passed on to the Swift center in the bank, from where it's seamlessly sent out to the beneficiary bank. Now, there was one guy sitting in PNB Swift center who had a password which he should not have had, where he could actually enter letters of credit. This is the old system. They are not revoked his password. So what he was doing was creating LCs with no record in the core banking system. And those LCs were being sent to beneficiary banks in Hong Kong. Nobody knew this was going on until some guy who was the beneficiary of that LC came and said, payment is due. When he sent the details to the Punjab National Bank, they said, no, we have no record of this LC here. Then the investigation started, and it turned out that Nirav Modi had done this trick of creating LCs whose record was not in the Punjab National Banking System, but through the Swift terminal. One little fellow in the Swift terminal office was actually sending out these LCs. Completely, it's a breach of internal processes, and that is what cost a huge amount. Now remember, LCs are legally valid. So when there is a claim from the beneficiary, it has to be paid. And this is where it went wrong. And it was a long time to get to the bottom of this. And this is why Nirav Modi is a crook. He defrauded the system. Because I don't know, we have no evidence of this. May have put a little clerk in that system to create these LCs. We don't know. But when this was caught, he just ran away. So I just tried to explain to you why Nirav Modi is a fraud. Kingfisher started as a genuine banking problem, but it ended up being a fraud. So to my mind, in the end, both these guys are frauds, but different flavors of frauds. Okay. If you have any questions, I'll be happy to take it one-on-one afterwards. You can call me on my phone and discuss this. But ladies and gentlemen, even to this day, fraud is very rampant in the corporate banking sector in this country. And that is because of low ethical standards by some borrowers and low ethical standards by some bank employees. And if they collude, it comes to light much later. And you know this, the guys who commit all these frauds are the people who know the systems best. And we are victims of a high level of automation because it takes a long time for us to find out that something is. I work very closely with the banking system in the fraud prevention. So I just gave you 2 examples based on the names that was floated. I'm sorry, at one point I had to raise my voice because there were some emotional reactions coming forth. I place the facts as I know them, and this is based on my interactions with the regulators. If you have any clarifications or any disagreements you want to discuss with me, please do so after the class, one-on-one, either on WhatsApp or on a phone call. Okay? Can we move on?
I'm Dhanshekharan, and it was an excellent presentation. And your banking association has given us a lot of knowledge. By the way, you are in which bank that time when Kingfisher was about to be funded? If you don't mind.
Oh no, when Kingfisher went bust, I was actually I'd already moved to IIM Bangalore. I moved in 2003, 2002 to IIM Bangalore. The Kingfisher thing broke out in 2009 as part of the global financial crisis where Lehman Brothers went down. So I was retained from IIM Bangalore externally to participate in some of those investigations. Because it took RBI a long time to find out what. Yeah.
Yeah, thank you so much.
I still don't know
one more.
Sir, one more. Sir, I'm Anbalagan. Sir, I'm Anbalagan from Singapore. Sir. Sir, can I talk? Can I talk?
Yes, sir. Go ahead, sir. Go ahead, sir. Anbalagan, sir. Please go on, sir.
Sir, 1 minute. I'm adjusting the. One. Sorry. Sir, Ruchi Soya and Reliance Communication, that deal is more lost to the bank than to the new buyer. This type of technique nowadays the corporate houses are using. What is your opinion on that, sir?
See, unfortunately, in a session like this, I will not convey my opinions because it's not fair. Because somebody will have a different opinion and we get in the same fight that we got into earlier.
No. This is not. I'm not the opinion.
I'll give you a very generic response.
That's what I will. It's like just knowledge.
I'll give you a very generic response. You know, a lot of these cases got referred to the NCLT because the Insolvency and Bankruptcy Code. Just to put it in perspective, I saw the first version of the Insolvency and Bankruptcy Code in 2008. And you know, you can't be the top 5 economies in the world when you don't have a bankruptcy law in the country. Because businesses will grow big, some of them will go bust. There must be an orderly method under which it can be done. 2008, this first draft of it was seen by me. Because of political reasons, it got passed only in 2017. Now, a lot of these loans had gone from bad to worse in the meantime. And in 2017, when the law it became law, IBC became law, and the National Council was set up. Most of the cases filed in the NCLT was by the bankers, it is not by the borrower. You go anywhere in the world, as I gave you the example of American Airlines and United Airlines and so on, files the bankruptcy petition. In India, the bankers are filing the bankruptcy petition because they said, these guys are not paying up, this is an avenue for us, let's pick up whatever we can. Now remember, in 8 years, the loan has degenerated to a point where these borrowers are very clever. They just said, boss, apne paas kuch nahi hai. All my assets are gone, this is gone, that is gone, jo marji le lo. I'm not speaking with reference to any one particular organization or company, but generally this was the case. And to me, sitting far away at a higher altitude and looking at all this, the paradox is the bankruptcy petition, that means to wind down a company, is moved to the court by the lender, not by the borrower. Borrower gets into difficulty, he goes to the bankruptcy court for protection. Here, bankers are going, and by the time the situation becomes so bad that in most of these cases, it was sold. And there are guys waiting in the sidelines, okay, I'll buy this company for cheap. Somehow the bank wants to settle it. So although the outstanding loans might be 10,000 crores, even if somebody pays 1,000 crores, they say, okay, take it. We will write off the remaining 9,000 crores, the case is closed. This is what has happened. And that is why a lot of the companies got sold for peanuts, not at the value that they commanded even at that time. We have mismanaged this whole thing because of delays. Had our bankruptcy court come into the country in 2008 when the first draft was announced, it would have worked. But politics prevented it from happening, and when things got completely out of control and NPAs become 14 lakh crores, in a hurry it was passed. NCLT was not set up. It was fully staffed. We didn't have an appellate tribunal. We're still learning. Even in 2024, it's unfinished business, but we are moving the right direction. I'm happy. So by 2030, 2035, we will have a bankruptcy environment in this country where the NCLT has learned from experience. We know how to deal with these cases. Borrowers know there is something called an NCLT they can go to under the IBC. Bankers will not be the ones who will be going to the IBC, NCLT from the IBC. This transition has to happen. These things take time, gentlemen. We are trying to look at too many things in too short a time. Had it happened in 2008, before the 2008 financial crisis, NPAs would not have gone to 14.5 lakh crores write-off. A lot of these companies would have gone for better value. But you know, this is business people. If decisions to hive off a business are not taken at the right time, the losses can be huge. And somebody benefits from that loss because somebody knows there is promise in this company, it's coming for cheap, let me buy it. This is the background. I don't know if I have to explain my point of view. If any of you differ in the manner in which I presented it, you can talk to me one-on-one afterwards.
Thank you, sir. Thank you, sir.
Okay.
Thank you,
Hello,
sir.
Professor. Can you spare some time?
Yeah, please go on. Please go on, Venugopal, please.
Okay. You see, while calculating IRR, there are a number of assumptions made for cash inflow and cash outflow because it's a period of 10 years and 15 years. When you do that, how reliable is this IRR calculations to make use of for the purpose of decision making for investment, either as a single investment or select for a limited resource allocation to, or selecting one of the 3 or 4 projects as you mentioned, using the same resource?
Yeah, interesting question. I'm going to ask you a counter question. The world hasn't come up with anything that is better than IRR to evaluate this. The world will, worldwide, continuously, businesses will invest in projects where they have to put equity capital, they have to raise debt, and the project time frames are 10 to 15 years. This is the reality. Now, with experience, we have seen that nothing can tell you today what the situation could be 15 years from now better than the IRR method, because it's easy to understand. 1. 2, the economy in India is strengthening. Today we have this any borrowing by borrowers, people who need money to take debt. You go to the bank, and the bank interest is also not predictable. It may go up in the 15 years, may go down in the 15 years. So it's difficult to predict the cash flows. I hope you understand what I'm saying. See, in this example, I have assumed it will be 10% for 10 years. How do we know? Which is why in the developed countries, they have something called a bond market. In a bond market, the coupon rate is the interest. This is a big subject. I'll be happy to talk to you later on. Because if the political belief that India will become the 3rd largest economy, we will have $10 billion, $10 trillion, the GDP, etc. Our present financial system will not sustain because of issues like this. We don't have a bond market. You know what happens in a bond market? I am the borrower. I can confidently go and issue bonds, and I know that I will have to pay only 10% for the 10-year period. Today I can't know, because there's no bond market, there's no corporate bond market. It is meant only for the large corporates and the big guys. Big companies can't go to the bond market. So you suffer an interest rate risk, because in your assumption, can you predict 10 years what the interest rate is going to be? You don't. So it could suddenly become 11%, 12%. or it will go down to 8%, 9%. So your interest cash flows are not predictable. Now, these are the serious systemic shortcomings in the Indian economy. And we are battling with the finance ministry and the RBI saying, let's have a bond market. Because don't throw the baby out of the bathwater. The best available methodology IRR. Whatever are the unpredictable components in the IRR, we need to solve. One is interest rate. The other is rigorously evaluate whether the cash flows projected by the company is realistic or not. This is the role of the board of directors, which is why corporate governance becomes so important. No? You know, lot of board meetings I just get called and said, we are evaluating the invest proposal. We are sending you the documents. Please read it. Come to the board meeting. You are not a member of the board, but you are an invitee. Challenge this proposal. So I asked them exactly the same question. How did you arrive at your revenues? How did you arrive at your costs? Is there a possibility that things can change? I'll tell you one systemic change that has come about in this country. You know why most of the toll road projects went into the red? Firstly, of course, reckless bankers who gave without doing proper analysis. Second is the revenue stream was unpredictable. Toll collection, some assumptions were made. Toll collection, some assumptions were made by the concessionaire. The realized toll cases was much lower than what is predicted. In some cases, it was much higher. So you know what the government has done? De-risk toll road projects. I don't know if you have heard of this called hybrid annuity model. It's called HAM. Now what happens in a HAM is the government will collect the toll on all the toll roads. That's why FASTag was implemented. Government is collecting the toll. Earlier, the company GMR Infrastructure Limited, for the first 5 kilometers, he will collect the toll. Then Nagarjuna Construction for the next 5 kilometers. They were collecting the toll and they were running the cash flow risk. I hope you understand what I'm saying. Now, Nitin Gadkari, he's one of the finest ministers we have in the government today, way ahead of all the rest of them. He came up with this model. He just told the NHAI, look, let's go and find out how it's done elsewhere. They all came back and said toll collection is centralized by the government. And on a pre-agreed basis, the NHAI will pay toll road operator on a pre-agreed basis. Now, the person who gets the contract is the one who was bid for the lowest pre-agreed amount. So it's paid once every month of the time periods. You can go and look at the hybrid annuity model for this. Now, why is this safe? This is because in some toll roads, lots of traffic, lots of revenue. In some other toll roads, the estimate went wrong, not enough collection. So if you as a concessionaire got the road where the toll collection is low, you're dead. Whereas another road where the toll collection is higher than expected, is laughing way to the bank. Now what has happened? Government said centralized. 1. 2. Operationally there were a lot of difficulties. Tolls were not being paid. Guys will allow.
He's joining in. Yeah. Yes,
Can you hear me?
Yes, sir.
What happened with the thing? Okay. So this is the way the toll road has been de-risked. The project has been de-risked. If you look at the 2011, 12, 13 context, we had toll roads, which is a great idea because private sector brought in the money. Government didn't have to put all the money to build the roads. Great idea. But in the execution, we found that the loss was being unfairly apportioned to the concessionaire. And it was a learning curve. We didn't know how to do it. And the toll operators went and hello?
Yes, sir. We can hear you, sir.
Yeah, I think it was 12:30 and the recording stopped automatically. Maybe
No. It's on, sir.
I hope. Now
One
the
more
point
question,
is,
Professor. Professor?
Yeah.
One more question. Okay, it is not
Go
relevant to
ahead.
this topic. I consider you as an expert and I am asking. See, with the digitalization, I'm seeing the borrowing is, instead of printing notes, they are just like that borrowing. For example, I heard State Bank every month they are going to take 10,000 crores as loan by submitting bonds. Is there any chance for Indian government to get into debt trap?
Okay, this is a very sensitive subject. Any growth, either in a company or in a country, brings with it errors, mistakes, pangs of growth, and we fix it. So the economic liberalization that started in 1991, which resulted in things like share trading, completely electronic, settlement completely electronic, toll road idea, all of these were born in the 90s as part of that economic liberalization. They have all brought with them certain negatives, and we are now in the process of fixing those negatives. If we didn't want 8% GDP growth, none of these ideas would have come up, and therefore none of these problems would have come up. So you can always look back and say, any growth brings with it pangs of mistakes, pangs of growth, as we call it. Like all of us went through our adolescence. If you put the clock back, we will say we shouldn't have done some of the things that we did. But it's all wisdom in hindsight. Countries are exactly the same. And that's why rapid. So when the government says we are allocating, several lakh crores for infrastructure projects, I'm a little worried, because I think the guys sitting in Delhi are not looking at overall what will be the implications of the banking system. Banks are not able to mobilize deposits, These things are not being considered holistically because everybody works in compartments. But if we didn't have this kind of growth, we don't have a problem. So growth brings with it a lot of mistakes. And if we are committed to it as a nation, we will make all of it work in the end. Think about it. When NSDL and electronic trading in NSE was started in 1992, there were lots and lots of problems. It took us almost 8 years to fix it. Today, you never have the worry that I have sold the shares, but I have not received the money. We cracked that. What is the problem today? Too much trading in derivatives. Level 2 problem. This is like when the automobile was built, nobody thought about accidents, because those days automobiles used to run at 40 kilometer, 30 kilometer speed. Today, every evolution in the automobile industry has to do with safety. Can it brake to a halt from 100 to 0 in 20 meters? This is not an issue that was discussed when Henry Ford found the first automobile. So it's a process of evolution. And how we manage the evolution is what is important. Today, the problem in India is rapid growth. Everybody says we need more roads, we need more infrastructure, we need more this, we need more that. Never a problem. All Indians will have a better lifestyle. All this is great. But what worries me, and my personal worry, you may disagree with me 100%, that debt of the government has gone up. Debt of the government from the public sector, from the banking system in India, has gone up from 50 lakh crores to 200 lakh crores. We don't know how much more it will grow. We need that. Nothing wrong with it. Government is borrowing to expand. And they are hoping, think about it, the problem very similar to what you and I face as individuals. When we find a beautiful house, we want to buy it. Then we will say later, let's go and get a loan. The EMI is very high. He'll see how to sort it out. I'll switch jobs if required in order to get a higher salary so that we can repay. We live in optimism, The government today is living in optimism. It is hoping that tax collections will go up. It is hoping that direct tax, indirect tax, all collections will go up. which is why Madam Sitaraman is taxing you and me on everything under the sun, because they need those cash flows to repay the higher level of debt. I hope you understand what I'm saying. Now, is it right or wrong? Time will tell. They pump the chest. Yeah.
You are right.
Go ahead.
Okay, thank you, Professor.
Thank you so much.
Nice. Okay, nice. Presentation by you. Nice teaching. Thanks a lot. This is
Okay.
Venugopal.
Okay, thanks. Is it time for me to sign off, or you? I have a couple of more things.
Yes, sir.
To look at.
Please go on, sir. Please go on, Professor.
Sir, sir, I have one layman question. So my point is very simple, sir. We are in engineers forum. People are, with a lot of knowledge to become entrepreneurship, and lot of people are already doing it. But still, many are in the belief, why not to put the money in FDs or mutual fund and try to earn like this? Where you are showing, lot of NPVs and many things, IRR, all those things. Totally, I feel it is wrong to put money in FDs or mutual fund. Not totally, at least some percentage. The engineers, those who have knowledge, they have to invest in entrepreneurship and ready to take the risk. Why it is not happening, sir? Can you just share your view?
This is a question in psychology, not in finance. Okay, you must read a book. What is the name of that book? The anchor theme in that book is fear of failure, hope of success. Fear of failure, hope of success. If you look at every entrepreneur, this is the dilemma he's running with. He sees a huge opportunity, and the phrase we use is, I'm going to take the risk. All right? Now, what is risk? Risk means there is a downside. Now, how do you hedge your risk? Which means when the downside comes, you should suffer the least. We are very selfish when the upside comes. If I start a company and the turnover is fantastic, my product became a big hit, I'm making lots of money. That's the hope of success that you get in. But the fear of failure starts setting in when you think the product is not selling. When you start, you don't know which way it's going to go. Which is why in some countries, the entrepreneurial spirit is much higher, even within India. Within India, let me say this. When I told my dad I want to start my own company, he shouted me down. Because I come from a very humble middle-class family where everybody has a job. Intrinsically, and at the level of our DNA, our risk appetite is very low. It's got nothing to do with anything other than beliefs. Why is there more Gujarati businessmen in this country than other nationalities? Because as a race, they're willing to take the risk and they help each other out. And tell me how many people in the Chettiar community in Tamil Nadu, since most of us are from there, run their own business? How many people who are Brahmins, Ayers, run their own business? I'm asking a very candid question. I hope you don't misunderstand what I'm saying. It has to do with the community you come from. It has to do with the kind of risk appetite that you've grown up with. You know, there's a little example which I'll share when it comes to risk. When I was in 3rd standard or 4th standard, I learned to ride a bicycle. And there was one guy near me, next door. His name is Sukesh, I'll never forget, because I use him as always an example to illustrate the concept of risk management. Both of us started learning to ride a bicycle together. My father was my trainer and his mother was his trainer. My father used to say, go on, ride the bicycle. First we had wheels on the 2 sides, he took it off. He said, drive. I said, Papa, I'll fall down. He used to say, look, you can't learn to drive a bicycle if you have not scratched your knees. Get on with it. Go for it. And then I couldn't synchronize braking, you know. So I'll go and hit a tree and the bicycle and I will fall, we'll get hurt. But I learned. He allowed me to take the risk. Cut to Sukesh and his mom. She always used to say, Paathu po thambi keela ulta vaala, kaala odachippa. Pathupo. That poor fellow Pathupo, he never learned to learn a bicycle. Risk averse. The guy got scared. Whereas my dad said, Chalao, Sala, you will get hurt. You know how to recover. Go ahead. The question is, what is your risk appetite? He didn't allow me to go to the road until I knew I could hold my balance. For me to drive to college, Loyola College, where I did my pre-university, from my house, which was 6 kilometers away, I used to go on bicycle. Only 4 years after I learned to ride a bicycle, because I got the confidence. Against me or alongside me. When I started, I didn't. So you learn experience, say. Certain pockets in our country are not risk averse as much as some of the other pockets in our country. I've given you that example. I wish I was born in Gujarat or in a Marwari family. I would have taken risks much more. But at the end of the day, you ask yourself, would you have made more money? And then when you get to my age, you ask a very philosophical question. Why do we need so much money for? Because my children don't need the money. So what am I going to do with it? Donate it to IIM Bangalore as an endowment? Why did they take all these risks? So I can donate money. It's a very self-fulfilling prophecy. So ultimately, it all boils down to your risk appetite. And your ability to take risks is going to be dependent almost entirely on your ability to do proper analysis before you take the investment decision and try to jump into it. One of the techniques that is used by a lot of individuals and companies is what we learned today. NPV, IRR, and other concepts of financing and investing decisions. I don't know if I answered the question. There's no easy answer to this. The answer lies within you.
Sir, you are supposed to tell something regarding the housing loan.
Yeah, I'm going to do that. That's the next topic I'm going to take up. Okay. Allow me a minute to get there.
Gobi sir.
Yeah.
Gobi sir, Nathan. Start our discuss பண்ணலாமா? Narayan sir, good morning sir. This is Nathan from this side. I am 84 Chemical.
Okay. From RC
sir,
is it or?
No sir, நான் வந்து சிவகாசி ஆக்சுவலா. நான் அண்ணாமலையில தான் முடிச்சேன். அண்ணாமலையில தான் 1984 Chemical. கோபி சார் சீனியர். ஒண்ணும் இல்ல சார், நம்ம பிரதர் ஒரு குரூப் ஆஃப் ஹெல்த் கேர்ல நம்ம பிரதர் வந்து டாக்டர் வெற்றிவேல் சொல்லிட்டு இஸ் ரன்னிங் a chain of hospital. 12 ஹாஸ்பிட்டல் ரன் பண்றாரு. 11 years ஆச்சு. Now he is facing some financial problem. Problem means வந்து ஃபர்தரா வந்து ஒரு ஸ்டெப் ஃப்ரண்ட் எடுத்து வைக்க முடியல. He is having some problem.
Okay. Can I interrupt you here, sir? Can I interrupt you here?
அதான் உங்க ஃப்ரீ டைம் சொன்னீங்கன்னா நான் இங்க கொஞ்சம் வாய்ஸ் கால்.
We will take this question offline, not in the class, because it's already 12:40.
Yeah. Okay. Okay, no problem sir. நான் உங்க மொபைல் நம்பர் வாங்கிட்டேன் 9841045066.
நான் பண்ணல. I'll give you. I'll share the number.
Free to call me or send me a WhatsApp message. I'll handle this question. This is one-on-one. May not be of interest to the rest of the class. Okay. Look, here are two types of loans. Here are two types of loans. You know, this one is what we are used to, EMI. I am assuming there will be 10 months. Housing loans are usually for 20 years, 15 years, and you repay every month. I've taken a very simple example. The loan amount is only 1,61,000. And there are two possibilities. This is an EMI loan where every month you pay 24,000. And in 10 years, you have repaid the loan. And the interest is 78,958. That's what you have paid the bank.
So the screen is not visible.
Screen is not visible? Okay, let me. Which one is it?
You can share, sir.
Okay. Sorry, in all this drum.
Yes, sir. Yes, sir.
Okay. See, there are two types of loans I've got here. One is both the principal amount is 1,61,000. I've taken small numbers so that we can easily understand. Inge, when the mortgage payment is EMI, like what we pay for a housing loan, 24,000 per month. Period is 10 years, interest rate is 8%. So let me go and explain this further. Masa 24,000 rupees you are paying every month. 24. Now, the loan amount outstanding is 1,61,000. At 8%, it is 12,883. So out of the 24,000 you are paying, interest is taken fully at 12,883 on the 161 at 8%. The balance amount is adjusted to your principal. Okay, so the balance principal at the end of the first month is 1,61,000 minus 11,117. The next month, your starting point will be 1,49,925, which is your closing balance in the previous month. Again, you are paying 24,000. Interest is 11,994. So the principal repaid will be 24,000 minus 11,994, 12,006. So that principal is deducted, and this is the way it works until at the end of the month. At the end of 10 years, the principal amount is 0. This is an EMI loan. How much interest have you paid? Interest payment is the total of this. So you have paid this amount as interest, and it works out to almost 79,000 rupees. What interest rate did I assume? 8%. So the bank is telling you, I'm giving you this loan at 8%. Okay. But you paid 7,895. Another loan, which is usually the practice in corporate loans, is 1,61,000. Interest payment on that is this. Here the principal repayment is constant. 10 varshatla varsha 16,104 is what we repay. So this is constant. So at the end of the 10 period, you repaid this. The interest you paid was on the diminishing principal. So if you look at our it will be 144,938 into 8%. So the principal is constant, the interest diminishing. And so here also you paid, but please note, given the interest is much lower than the interest in the EMI loan. 8%. So when the banker comes and tells you, I'm giving you an EMI loan at 8%, what you are actually paying is more than that, which is borne out by this. Okay, so you're actually paying more than 8%. Don't get fooled into believing you're paying only 8%. In this kind of loan, which is what happens in corporate loans, the interest rate is 8% over the time period. And this one, again, uses this NPV formula, what I tried to do here, and calculated and said 1,61,041 over the 10-year period. Each one of them I calculated using the NPV formula. So I'm going to leave this with you. You guys can work through it. Your housing loans follow this pattern. Housing loans follow this pattern. Most corporate loans follow this pattern. In both cases, the loan amount is 161. For my internet connection, is able to I think. Disconnect my internet and read. Can you hear me?
Yes, sir. Yes, sir. Yes, sir. We can, sir.
Okay. Hopefully, it should be less of a problem now. Yeah. Right. So the reason why I tried to tell you is I've used the same net present value formula here as well. If your loan amount is 24,000 is what you are repaying over a 10 period, at 8% interest, the NPV will be 1,61,042. Taking a loan of 1,61,042, interest rate of 8%, time period 10, what should be your monthly cash outflow for EMI? You've seen this EMI calculators posted by banks and housing finance companies. EMI calculator. You give any three variable, he will calculate and tell you the fourth variable. This formula is what he is using. I hope it is clear. Suppose you say, I want 1 crore loan. 1 crore loan is what is being given today. Okay, 1 crore loan is being given today. How much can an EMI be? I want a 15-year loan and the bank knows the interest rate is 8%. They'll come back and tell you, you have to pay 72,000 per month as EMI. So you say, no, 72,000 not possible. How much can you pay? 60,000. So they give you 60,000 and they'll give you two alternatives. Sir, either you have to take a house which is cheaper, less home loan, or increase the time period so that you have become eligible at 60,000 for the same 1 crore loan. This formula is fundamental. Net present value formula is what is used in your housing loans. This is the point I want to. Is it clear? Is it understood? Can I move on?
Yes, sir. Yes, sir.
Okay. Now, I'll take you to the last issue, which is my favorite, one of my favorites. We're all confronted with this pension payment problem. Pension. How much should I save for my pension? Correct? We're constantly bothering. இப்போ எனக்கு 40 வயசு 65 வயசுல ரிட்டையர் ஆக போறேன். What should be my income at the age of 65? We are confronted with this problem. You know, our parents didn't have this problem. You know why? Because the social net in the Indian context always was educate the children, get the daughter married off, get the son to a good college and get him to educate and get a good job. The children will take care of us in our old age. And in return, we will take care of the grandchildren when they come back from school, etc. It is an undivided family, one house. This was in my father's generation. So until my parent passed away, they stayed with me. They stayed in my house. He didn't have the problem of where is the money to buy groceries, etc., etc. But ladies and gentlemen, with economic development, families have become unitary. And me in my family, I have told my son, he's already working. I said, I will educate you. I'll help you find your job. After that, you for yourself. Go and find your own wife. If you want my help, I will offer. Otherwise, you're independent. We will come and visit you on holiday. You can come and visit us on holiday. Arm's length. Lots of middle-class families becoming like this. Which means I need a pension. Because, you know, one of the shocking things that happened to me when I retired from IIM Bangalore, if I had not managed my finances, from the 1st of July, my salary credit will stop in my bank account. I had just taken it for granted. With that salary credit, I would invest, I would buy grocery, I will do this, I will do that. Money was flowing, cash inflow every month. When you retire, damn thing stops. And if you have not planned for it, you're in shit street. And it's very difficult to plan because nobody knows at what age they'll die. You may die at 55, 60, 65, 70, God knows when we will die. So pension planning becomes a very important subject, which is why there are so many financial planners who will come to you with all kinds of solutions, including institutions like LIC. Now, I'm going to take you through an example of why this problem is so severe, and that will be the last one we will deal with. So here we go. I make some assumptions here. I'm 30 years old, and I'm going to retire when I'm 60, so I have 30 more years to go. And at the age of 30, I'm saving 20,000 rupees a month, 2,40,000 per year. So everything in year terms I'm calculating. Now this 2,40,000, I invest it wherever, and let's say I'm getting 8% return on it. I call it interest rate. You can put it anywhere. If you've got the risk, you can invest it in mutual fund, whatever. 8% return is what I'm getting. So this 2,40,000 which I invested at the age of 30, for 30 years it is accumulating interest at this 8%. and it will become again future value formula now. 2,40,000 into 1 plus 8% at for 30 years. So it has become 24,15,000. I started at the age of 30. I saved 2,40,000. When I hit 60 years by the retirement age, it has become 24,15,000. Every year I'm going to increase it by 1,000 rupees. Sorry, 2,400 rupees, 200 rupees a month. Sorry, yeah, 200 rupees a month. So at the age of 31, 29 years are left, and the amount I put in is 2,42,400. And how much will be in my retirement pension accumulation? 22,58,000. So it goes on and on until I am 59 years of age. So I didn't bother at all. Every year I started with 2,40,000, 1% increase into my pension fund. I've hit the age of 60 now. At the age of 59, I've invested what I started with 2,40,000 at 1% increase every year. It is now 3,09,600, but it will accrue interest only for 1 year. So that amount is 3,34,000. So if you look at all the accumulated amounts, my total is 3 crores 20 lakhs. I didn't bother. Every year I was putting 20,000 rupees per month, incrementing by 1%. When I retire, I've got a corpus of 3 crores 20 lakhs. I didn't even bother. Put it like an SIP, you know, this is what they say. Keep putting the money SIP. It will grow. It has grown. Okay, now, age of 60, retirement has dawned on me. What is my corpus when I retire? Pension corpus 3 crores 20 lakhs. Now, this is future value calculation, not present value calculation. I'm using exactly the same formula. 3 crores 20 lakhs. I'm earning 8% that. Now, this is my corpus. I earn 25,64,000. Okay. Yeah.
Hello. Yes, sir. Yes.
Yeah. When I was at the age of 30, I needed 30,000 rupees a month for my expenses. So in 1 year, it is 3,60,000. At an inflation rate of 5%, gentlemen, listen very carefully. At the age of 61 or 60, when I retire, sorry, I have to share screen.
Yes, sir. Screen is not visible, sir.
Screen share. I think the computer and Zoom are tired. Screen share. I think my login has gone on. Can you hear me?
Yes, sir. We can hear you, sir.
But then how do I bring back the share screen? I can't see that anyway here.
Share because, sir. You're still the co-host.
Huh?
You're still the co-host, sir. You can share, sir.
No, but that bar where it says share screen is gone. That's my problem.
Oh, okay. PS, can you help?
Sorry?
I'm just telling the IT guy to see if he can help you. PS.
Where did it disappear? It usually is here.
Okay, you proceed, sir. Proceed, sir. No problem.
No,
So press escape and try to see somewhere.
Mm-hmm. Can I just log in again, or will it allow? It won't allow me to log in.
It will allow you, sir.
Hmm?
It will allow you. Why not?
So why not? I'm சொல்றீங்க it should cause more product. Yeah, this is happening too late in the day. You went on said very well so far.
Yes, sir.
No, okay, I'll just sign in again.
Yes, sir.
I've gone to the link. I'm signing in again. Let's see what it does.
Yes, sir.
Zoom. I don't think it's letting me open again. Okay, share screen. Can you see now?
It's coming. It's coming.
Yes, sir. It's come, sir.
Okay. Okay. So what I was telling you was, at the age of 30, I was spending 3,60,000 per month, 30,000 per year, 30,000 rupees per month. Now to maintain the same standard of life, when I hit the age of 60, that means 30 years later, the amount of expenditure I will incur is 3,60,000 into 1 plus 5%, which is the inflation rate, to the power of 30. 60 minus 30, 30. So to maintain my standard of living at the age of 60, as what I did at 30, I will need 15,55,000. Now, how much is the pension I'm earning? 25. Okay. Can you hear me?
Yes, sir. We can, sir. We can hear you. We lost in between.
So, yeah, at the age of 60, I will need 15,55,000 to maintain my same lifestyle as I did when I was 30 years old. I hope you understand the impact of inflation. So net, what I'm saving is 25.64 lakhs, which is the interest I earned on my pension corpus, minus 15.5 lakhs, which is the expenditure now I'm incurring. So I am adding 10 lakhs to my pension corpus. Is it clear? So if you look at this, it has gone from 3,20,000 to 3,30,000 because I've added this 10 lakhs to my pension corpus. Then again, same calculation goes on and on. Is it clear? So if I look at this 4,30,000, this is the interest I've earned. This is my expenditure level now. Go further. This is the expenditure level now. So if you look at the pension, adding the amount is reducing year after year after year. Until up to here, my pension is, corpus is increasing because there is addition every year. But in my 78th year, the 5% increase in my expenditure is more than the interest I'm earning on my pension. So that means pension starts depleting. My pension amount will keep on decreasing, as you can see. And I better die at the age of 94 because my pension funds would have been fully exhausted by the time I hit 94. Is that argument clear? I started with 3 crores 20. It kept on increasing because the interest earned minus the expenditure was higher. And then after a while, at the age of 78, the pension, the corpus starts diminishing and gets wiped out at the age of 95. So if this is my pension plan, I better die before I'm 95. Because after 95, I don't have money to live. Now, hopefully, most of us would not live up to the age of 95, so we are okay. But if you're the odd guy who's going to live more, you will have to plan for it right away. Now, think about it. All pensions when you write a pension, they will tell you who should be the beneficiary when you, in the event of your death, who should get the money that is lying in the pension. If you died at the age of 74, the balance in your pension corpus is 4 crores 45 lakhs. Who should get that money? You have to give this. You have to give them in the term documents that you submit, and they will get the money. So if I say 50% to my son, 50% to my daughter, 2.225 will be given to my son, 2.225 will be given to my daughter, and the pension fund is closed. So I leave them with a certain sum of money. Now my children get hold of this spreadsheet, both my kids, and they look at it very carefully. Acha, we get a lot of money if Papa dies. But if he's going to die at the age of 90, we only get 1.24 lakhs, 1.24 crores. But if he dies at the age of 74, we get 2.25 crores. So there is a desire for daddy to die earlier than later if children are very commercially oriented and they want more pension, more of your pension. The inflection point is they look at it very carefully and they say the optimum point for Papa's death is the age of 78. Because at 78, we will get 2.28 crores each of us. But after that, it starts diminishing. So my maximum return is if daddy dies at 78, and minimum return is after he dies at 94. If he dies at 94, I get only 6 lakhs. If he dies at 78, I get the maximum, and everything, all other numbers are in between. Now, this kind of pension planning is necessary for every individual because, as we saw, all it uses is the time value of money, the principle of compounding. So you save when you are active in active professional life, and you start using that pension corpus when you retire, and make sure the arithmetic works in such a way that it will close out at least till the age of 1995. Now we got a problem here. Can you tell me what are the assumptions I have made in this calculation? Any one of you? Can you tell?
Inflation and interest rate?
Yeah. I have assumed them to be constant through this period. For example, if at the age of 60 when I start, if inflation has gone through the roof and it has become 7%, look at the impact. I've run out of my pension fund by the time I'm 74. All right? In the same way, if interest rate reduces to 6% by the time I'm 60 years old, I'm in trouble. Not so much in trouble. Did I say 7%? 6% interest rate. Yeah, at 85, I'm dead, not 94. At 84, I'll run out of pension. Earlier, I was running out of pension only at 95. So both these parameters are extremely important, which is why, you know, this whole thing about India is becoming the third largest democracy in the world, Havana Dimkana. I just sit back and I say, can we reduce inflation as much as possible and keep our interest rates as a result as low as possible? So if when you hit the age of 60, inflation is 2% and interest rate is 5%, it will make no difference to you. In fact, you'll do much better. So going forward, governments have a responsibility and RBI has a responsibility to make sure inflation is kept as low as possible so that interest rates can be kept as low as possible. And therefore, this whole longevity and pension planning and everything will be more significant. It can't be volatile. You know, it can't be 8% today, it can't be 9% next year, and it can't be 7% year after. You can't plan your pension. There has got to be an interest rate inflation scenario that is very predictable. This was not the case in India 40, 50 years ago. Thanks to the economic liberalization ushered in when Prime Minister Narasimha Rao was the Prime Minister and Manmohan was the Finance Minister, Manmohan Singh, we came up with an architecture where today RBI is able to say our inflation will be around 4% plus minus 2%. We couldn't do this in 1990 because we had a very unstable economic situation. Similarly, most of us are okay with interest rates at 8%. And interest rate is directly correlated with inflation. Those of you who are interested, there is a Nobel Prize winning theory by Irving Fisher. It is called the Fisher effect. Go and read that on the internet. Nominal interest rate equal to real interest rate plus expected inflation. That's the simple formula. That's what is used. And every time students of economics, policy makers are looking to make sure that that equation is obeyed. Because I'll tell you why. If inflation is 8%, but interest rate offered by the bank is only 6%, you know what? You're becoming poorer every day because your money is growing at 8%, but your expenditure is growing at 8%. You can't afford this. Inflation rate always has to be lower than the nominal interest rate. This is the theory that is expounded, which is a Nobel Prize winning theory around which most economies, macroeconomic policies are structured, which is why whenever inflation goes up in any country, there is pandemonium because interest rates will automatically rise. And even the US had a problem recently where they had to bring down inflation, and now they're talking about a more stable situation. So you can't think of this happening in Somalia or Swaziland or wherever, where they don't have an economic policy framework which looks at inflation and interest rate and be able to predict it with reasonable accuracy. This is the whole idea of, and please note in this spreadsheet, time value of money is used, future value, present value to future value, present value to future. All other examples we saw were future value to present value, investment decisions. In your own pension planning, it is present value computed to future value because you're looking at today how much I should save so that I have a retirement corpus at the age of 60, right? So I'll be sending you this spreadsheet as well. Go through it. If you have any doubts, do feel free to call me. That brings me to an end, the formal points I had for discussion with you guys. Time is already, what, 1:15? My God, we have overshot by an hour and 15 minutes. Apologies for that. But I hope the session was useful today. And if you do have any questions, do post them to me, either on WhatsApp or on my email ID, and I'll be happy to respond. Gopi, you can take over.
Yes, sir. Yes, sir.
If somebody has any questions, I think everybody must be quite exhausted on Sunday afternoon.
Sunday afternoon, yes, sir. Anyway, thank you very much for the excellent session, sir. I'm extremely sorry for that episode what Mr. Sampath had created. We are very sorry about it.
It's okay. It was half knowledge is the dangerous thing. That's what I would say. You go by headline, and your brain gets screwed up, and you ask all these questions. It's okay. I'm very forgiving of these kind of questions. I only ask that if people have a strong opinion, they should allow it to be challenged through data and facts and good theory. That's all. That was what was missing, which is why I also lost my cool. Because the person was just reiterating what he was saying instead of hearing me out on. I'm repeating what I said. If we had an insolvency and bankruptcy code in 2008, Malia would not have happened. A Nirav Modi would definitely have happened irrespective because it was a fraud. You know, these are points we should understand as business people. So when you see the IBC, you know, there is a reason for it. It's a business reason for it. It's not a legal thing. It's not law. You need it. This is the point I'm trying to make, and somehow it got distorted, and I was racing against time, so I also didn't handle it the way I should have. Apologies for that. Okay.
Can I have a word?
That,
I would like to just have a word.
Yeah.
As an entrepreneur, when you start your career in your 30s, obviously profit and money is what motivates. But when you move to the 60s, the priorities are because you know how many people you are able to give employment, how many families you are able to take care. Your purpose of entrepreneurship totally changes, sir. As we age.
Yeah.
Because actually it's not the children. I mean, because they are not interested in a small enterprise with all their qualifications. So it is your workers and your staff. They actually become your family.
They depend on you. They depend on you with their livelihood. I agree. They depend on you for their livelihood.
Yeah. The other thing is, after paying taxes, interest to the banks, bad debts, everything, I find that only the real estate is there. Actually, though we call ourselves industrialists, actually we are real estate people, because at the end of, after spending all these years, the value of land where you put up the industry, that goes up. Actually, that we actually become we are into real estate, not really industry. I mean, you realize after 30, 40 years.
Yeah, that's a very interesting point you raised. I have a quick answer to that. You know, the rate of appreciation of real estate in this country was very high. It is not continuing to be anywhere near as high going forward. Let me tell you the reason why. Financial assets like equity stocks and so on and so forth, there's a retained earnings which is plowed back and then that appreciates the value. In real estate, it is just the demand for real estate that is appreciating. As a case in point, I bought my first house in 1987 for a princely sum of 6 lakhs in Bangalore. Today, that house is worth a little over 2 crores. My son bought a house in 2012. Today, that house is not even appreciated by 15% over a 12-year period, whereas mine is appreciated from 6 lakhs to 2.5 crores. So the play on real estate in this country is over. So if somebody were to buy land and build a factory today, 10 years from now, he would be saying the same thing as what you're saying. Now, if you had bought a land, built a factory 25 or 30 years ago, you're sitting on a tidy profit, just like I'm sitting on a tidy profit in my house. Because real estate and gold are non-financial assets which do not grow on their own. It grows based on demand, speculation, etc., etc. Whereas financial assets grow on the performance of the company. So if you had invested in Reliance or L&T shares even 5 years ago, you'd still be sitting on a profit because those companies are doing well. That's the difference. So as the economy matures, you will find people prefer to invest more and more in financial assets rather than in physical assets like gold, real estate, etc. This is a process of evolution. We'll park this question now. 20 years from now, we will revisit it and you will find that more people have moved to financial assets. Today's youngsters are only talking about mutual fund, equity shares. My mother, when I took up my job, she said, "Modarla veedu vaangada. Somehow save and buy a house." For loan kuda kedayadu, but because it was appreciating. And she said, buy some gold and keep it in the bank. You know, this was the country evolves over time. People's priorities change, types of assets change. Today, you should have a portfolio of assets. You should have some gold, you should have some house, you should have investment in real estate, you should have investment in equity shares, you should have investment in your own company. It's a mix of law.
Thank you, sir.
I hope I've answered that question.
Thank you, sir. Thank you, sir.
Sir, you worked in a bank?
Hey, I'm just wrapping up. I'll be done in a couple of minutes. That's a call from my wife. We were supposed to go out for lunch. She's hungry and she's 45 minutes late. So yeah, this will be the last question I'll take.
Yes, we'll have the last question, sir.
Yeah.
Sir, you worked in a bank?
Yes, 20 years.
Which bank, sir?
For the most part, I was in Standard Chartered Bank overseas, and I've done banking business in several countries around the world, at least 22 of them. Because as an international officer, we were posted to various countries. So that variety gave me a lot of learnings. Every country was different. So that was my banking experience several years ago. And when I came back to India, I joined the bank, but I found the state of affairs here extremely shocking. The way business was being done, it lacked maturity, it lacked support of law, and this I'm talking about in the 90s, late 90s. So that's why I decided to move into academics and work with the regulators in the banking system from outside to strengthen the banking system in this country. So that mission has been very successful, particularly in the technology area. I was actively involved with the Reserve Bank and several of the banks in implementing the core banking system, connecting all the branches, implementing, and more recently, NEFT, RTGS, working with the National Payment Corporation of India to implement all of those. And then I was co-opted by Nandan Nilekani to be part of the Aadhaar project for the direct benefit transfer, a whole host of things. So my contribution in India in banking is more at the macro level. Plus, of course, participating in a lot of the policy decisions with the government and the banks and finance ministry and so on. My banking career in India was not extraordinarily long. And may I say, it was a bit painful as well, the few years that I spent in the banking industry in India. But I learned a lot. I knew what needed to be done. Have I answered your question?
Yes, sir.
Sir, which course you will suggest, sir, for younger generation, along with in finance, if he has to take along with engineering?
I don't know the short answer to that question. But you know, I wouldn't, if you've been if you've been working for many years, I think you should resort to technology-based learning. And there are several organizations that offer online courses. Some of my courses also run on the internet. It's easier to learn at your own time rather than go and sit and do an MBA program or whatever. Very expensive, very time consuming, and lose 2 years of your career. Unless you do it part-time, in which case if you have a family, it tends to be a big strain on the family. Make sure your wife is fully supportive of your decision, because part-time MBAs take 3 years. It's the best solution if you don't want to give up your job. If you can give up your job and accelerate your learning, do a 2-year MBA program in a good school, in a good business school, or a part-time MBA program which will last for 3 years. In fact, these days they have compressed executive education MBAs, executive MBAs for 1 year, 15 months. You can try any of those, but they're very expensive. The other way to learn is background learning, where you work on a lot of the online courses that are offered these days.
You are offering any online course, sir?
Sorry?
Are you
I missed the
offering any
question.
online course?
No, I don't offer it. It is on a platform called SWAYAM, which is a Government of India Ministry of Education platform. Some of my courses run there, but they're very specialized courses, you know. One is on equity markets, another one is on bond markets, and the third one is on risk management. I don't offer, so if you want to learn risk management, there's a good course that is running on the SWAYAM platform, www.swayam.com. Go in there, type in my name, you'll find that course. You can go and look at it. Or if the group is interested, I can forward the links to those courses and you can take a look. Gopi, just send me a reminder. I will.
Yes, sir. I will do that, sir. I will
Please,
remind
sir.
you.
Thank you very much, sir. Really appreciate.
Gopi, I have a
There
suggestion
are
for you
plenty
here.
of courses on the internet. You don't have to depend on me. Okay.
Yeah. Gopi?
Yeah.
I have a suggestion for you on this question. In fact, I was thinking on this for quite some time. Like what sir said, we can suggest to the engineering faculty if they can provide elective courses in the last 2 semesters, something like finance for non-finance people. We already have electives.
Yes.
So this will make a huge benefit for those who would like to take up to business finance for non-finance folks.
Fine, sir. Fine, Anand.
We have a course in IIM Bangalore which is called Finance for Non-Finance Executives. It's an executive education program which runs for intermittent. No? Then you do your projects for then you come for another 3 days.
Yeah, I was trying to suggest that for the final year students for the engineering. We have in economics actually. I was trying to suggest that for finance.
Okay.
Yeah, sure. We'll do that.
Can we sign off, because my wife is threatening me into the car now?
Sir, one last minute. NSF, Sir Murthy sir, can you just share your...
Yes, very nice, PC. Thanks to you. And in fact, it's my dream of studying in IIM has been taken care today by your Excel sheet and all the presentation. Normally, presentation means PowerPoint presentation we used to get, but today you went through all this calculation. Really remarkable. Thanks to PC for your time, and then you gave a good input to all of us. Excellent. That's up to you.
Okay.
Thank
you. Thank you very much.
I hope it will benefit to the participants. Thank you very much.
Thank you very much. Thank you very much. Thank you.
Enjoy the rest of your Sunday. Bye bye.
Thank you.
Thank you, sir.
Thank you.
Thank you very much, sir.
Thank you, Mr. Narayan.
Okay, thank you very much.
I was your junior at REC Trichy.
Oh, really? Which year did you pass out?
Emerald Hostel.
Sorry?
Emerald Hostel.
Oh, Emerald. I was in Lapis.
Yeah, you were in Lapis, I think, right?
Yeah.
I was in 71, 76.
Okay.
And I think Ramaswamy, my cousin, was your batchmate, metallurgy.
Oh, yeah. JR. We used to call him JR.
J. Ramaswamy.
Yeah,
he happens to be my cousin.
He used to work for in Dubai.
Balco. From then Balco, he went to Dubai.
He was in Balco. Yeah. Then he went to Dubai. Yeah, that's the guy.
I'm also ex-IMB.
Okay.
8082.
Oh, I see. You did your MBA at IIM.
8082 when Mr. Ramaswamy was there.
Yes, Ramaswamy was.
Yes. I think my classmates are your fellow faculty. Giri and N. Ravi.
Yeah.
N. Ravi, IFS, retired IFS.
Yeah, I know N. Ravi.
And then Giri. And Giri is on finance.
Yeah. Giri, his name is
we're all batchmates, 8082.
Yeah. Sabrinathan and I are the colleagues.
Sabrinathan, correct. Giri Sabrinathan.
Yeah. Okay.
So nice listening to you today. I was a great admirer of you in REC debate.
Sorry?
I was a great admirer of you in debates in REC. Remember intercollegiate debates? I used to listen to you.
Correct. I used to be quite active in that circuit.
Bye-bye.
Okay, great. Having all of you. I'll sign off now.